In the previous video now, I introduced you to the concept of depreciation and book value and the gains that you can have on assets when you sell them. And I'm now going to bring you through a little problem here to show you how to do these things, how these calculations are done. Now, we're going to use straight line depreciation. That's not the only depreciation technique, but it's very common and probably the easiest one to understand. And to do depreciation expense now with straight line depreciation, there are three things that you need. You need to know the depreciable value of the asset, you need to know the salvage value of the asset, and you need to know the economic life of the asset. Now, depreciable value for an asset, that's not the same thing as the price you paid for the asset. Depreciable value is actually the cost of putting the asset into operations. So buying the asset, what you pay for the asset, that's a piece of depreciable value. But if you had to ship the asset to your business, if you had to run special utilities for the asset, anything like that to put the asset into operations now, all those things add up to be depreciable value. And that's what you get to write off, and that's what you get to depreciate. Salvage value, on the other hand, that's what you think you can sell the asset for at the end of its economic life. Now, that's not a number you should make up. Your vendor who sells you the asset, they can probably give you a good idea of what the value of the asset would be at the end of its economic life. That would be a reasonable thing to do to come up with salvage value. The vendor could probably also give you a good idea of what the economic life of the asset is. So all these things that you put in, some are calculated, some you have to have some type of reason for using the number. But in this problem that we have now, this is an asset with a depreciable value of $100,000, a salvage value of $20,000. So we think at the end of its life we can sell it for $20,000, and an economic life of 8 years. So if we spend $100,000 a day to put this asset in place, we think that we could sell that asset for $20,000 8 years from now at the end of its economic life. Now we're going to calculate the straight line depreciation. The depreciation expense per year using straight line depreciation now is the depreciable value of the asset minus salvage value divided by the number of years of economic life. And 100,000 minus 20,000 divided by 8, that gives you the depreciation expense per year, which is $10,000. So every year that we own this asset, we're going to be able to avoid paying taxes on $10,000 of income. That's what depreciation expense means to me and you financial managers. The IRS would like you to know that if you avoid paying taxes on too much income, they're going to come in, make you pay up on those taxes. And that's what we'll get to when we get to depreciation and its impact on the selling price of the asset. And again though, depreciation recapture, that's the IRS saying you depreciated the asset too much, you avoided paying taxes on too much income. And this problem will get to that scenario and talk about that some more. But this is a little example on how you would calculate straight line depreciation. And again, the depreciation expense per year on this asset would be $10,000.